would like, if I may, to take you on a strange journey.
Hello, you stunning rebels, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Welcome to Tuesday, September 20th, 2016. Hope you're all getting a good start on the week. Best way to reach out, head on over to the website at therebelbroker.com. Once you're there, please feel free to click the Take the Survey to Support the Show button. When you take that survey, you will be put in the drawing for a $50 Amazon gift card, which is going to be happening on October 1st. If you're someone who has already taken the survey and used an email address, you are golden. You are in the drawing. No need to go back. If you took the survey and you did not include your email, you'll want to go and do that again. The only proviso is you need to enter your email address twice. You'll click that button. You'll go to a screen that lets you enter your email address and your name. And the email address, then you'll click Take the Survey, and the survey you go to, those two emails have to match. They have to be the same email address in order to get officially entered into the drawing. And we will do a drawing every month. We'll do a drawing on the first of every month, so it's one of those things where you may get more than one chance to win. So I've gotten a pretty good response so far, so a few of you folks are now added to the potential list of folks who are going to come away with $50 come October 1st. What else have we got? Oh, and I've also added a new way for you to subscribe to the Rebel Broker newsletter. If you are interested in getting on the list, and this isn't just a newsletter thing, and as always, this is not something that I share with anyone else. This stays strictly under my control. And what you're going to get is basically any content, materials, updates, those types of things are going to be specifically for folks who are on the Real Estate Reality subscription list. So that may be an occasional newsletter. So probably not, you're not going to get your mailbox full of stuff all the time. This is going to be things like some exclusive content where I create a different helpful documents, maybe cheat sheets for different things, and send those out to the folks who are on the list. A newsletter that I'm entertaining the idea of doing on a semi-regular basis. I'm still fleshing out exactly how I want to do it, but I'm thinking starting off probably doing something once a month, which will sort of expand on some ideas, maybe give a little bit more resources in terms of things that you can then chase down yourself if you want to do some more of your own work. And then, of course, advance notice on projects that I'm working on. So if I'm working on a video that's something specifically for video, like a how-to video, or if I want to put together some sort of longer form training or seminar type thing, those are all things you'd find out ahead of time, and you'd also get an opportunity to give me input on those things. So it's definitely more of a community thing that I'm hoping to build here in terms of being able to have an exchange of ideas and folks being able to get advanced information on things I'm thinking about doing. So if you want to go ahead and participate in that, the two ways to do it are to text the word Rebel Broker to 44222, and then follow the prompts that you will be replied to with, and then you will be added to the list. So feel free to do that. Again, to participate, text the word Rebel Broker to the number 44222. So that's 2 4s and 3 2s. And text the word Rebel Broker, answer the prompts, and you'll be added to the list. Wow, I think that's it for housekeeping stuff. We're going to go ahead and talk about what I mentioned yesterday. There was actually 2 interesting articles that kind of talked about the housing market in general. One was very much more specific to California and sort of theorizing about whether or not the boom has come to an end. But there was also more of a general article titled, Anxious About Real Estate, 6 Trends Making Housing Worrisome. So I think, and this article is less in the theme of a softening market or things coming to an end. It's more things that are concerning about this market. And I thought they'd be good to review and see what we think about these various things. Now, this article comes to us from the Orange County Register. So clearly, I think these are observations that are probably from the perspective of folks in Southern California. At least that would make the most sense to me, given who's putting this out. To quote the article, after a heady recovery from post-crash lows, real estate values in many ways are back to roughly where they were before the last dose of harsh reality hit housing especially hard. The early warning signs of any pending real estate boom to doom would show up in the industry stats. Sometimes they do, but usually the best way to find cracks in the property game's economic foundation is to listen carefully to real estate chatter. When it sounds too good to be true, too confident, a little off base, or even somewhat whiny, be careful. I love that line because I think it fits in perfectly with a lot of things we've talked about here. And it's been in the context of a lot of different things, right? So whenever we cover different story items, one of the things I always like to do is approach it from the standpoint of understanding the perspective of who's writing it and why they're writing it. Whenever you get something from the National Association of Realtors or any industry that is inextricably linked success-wise to a robust real estate market, and unless it is an absolute, undeniable, blatant thing, you can typically count on the most optimistic interpretation of the data. This is a frequent complaint of mine. It was one of the way early when I started this show back in January of 2007. That was really one of the things that was a major theme. There was a lot of dissection of things that were coming out of organizations like the Association of Realtors and the Association of Lenders, all these various organizations that support different aspects of the real estate world, and how they were really missing the mark, intentionally or not, in terms of how they were interpreting data. And this is also something I've warned you all about in terms of just, when you hear these things and you read those headlines, oftentimes you'll find just read the story and you'll discover, well, you know what? They left out this. And sometimes the things that are the most educational in these articles are the things they don't mention. And I suppose that's one of the things that frustrates me, because in a lot of cases, the only people who are going to think of what they didn't talk about are going to be folks like me who do this on a regular basis and actually bother to spend any time kind of, that's not fair. I'm a numbers wonk. And I get that a lot of real estate agents are not numbers wonks. So maybe it's unfair for me to expect them and more of them to do that kind of thing. But the reality is that if you're really in this business at all and you've been doing it for any kind of length of time, or you've even educated yourself, there's no requirement you have a real estate license or have sold 50 houses for you to understand this stuff. But if you're thinking your way through it, you realize that there are aspects of these stories that are not being discussed. There was another one. There was an article today. Man, if I go into the weeds on this one, I'm never going to forgive myself. Something that I thought was very interesting, because just as an example, and hopefully this won't drag us too far into the weeds, was statistics, right? And that's one thing that we dissect here on the show. And a big piece of news that came out on Monday was this 5% increase in household income. And of course, that's absolute complete bull. There was no 5% increase in income. So what were some of the quotes that were particularly annoying to me? Where was it? I apologize. I wasn't actually intending to talk about this one, but there was a quote, and I believe, if I'm not mistaken, I believe it was Hillary Clinton in a speech. The average Americans just got a huge income boost, and that's absolutely not what has just happened. Let's see here. It was from the Census Bureau reported that real, adjusted for inflation, median household income rose 5.2% between 2014 and 2015. Of course, the impression that they're giving and the way people are then, I guess it was the Huffington Post that put out this article. And man, I tell you, you will frequently find I don't tweet Huffington Post articles, and when I do, it's usually to point out how horribly misleading or incorrect they are. But of all the different sites I read, I think Huffington Post has the most patently idiotic stuff of anyone of other ones. Well, with the exclusion of anything relating to Alex Jones. I can't remember the name of his site, but that's nuts too. But anyway, the point here is that we have to understand what median means. Median doesn't mean that average Americans just got a huge income boost. That's not what that number tells us. What that number tells us is if you have 51 numbers, and the number where 50 people are above that number and 50 people are below that number, that's the median. Right? That doesn't tell you anything about what the bulk of people are earning. It could simply be that a very small percentage of people are suddenly seeing a very large increase in their yearly income. It could literally be that whole 1%, 3%, 5%, 10% of the population that through whatever efforts they've been putting out have managed to garner a much larger income per year, which would then skew this whole median thing. So it doesn't skew the median because the median is what the median is. But the bottom line is it's people misinterpreting what the median is, and then these folks who should know better. And I think what really annoys me about this is anybody who just sat down for a couple of minutes to look at the core data, not even look at the core data, use the terms used relating to the numbers that they think are so important before they write their 300-word story for the day, you'd think they'd get what that actually means. You might have Googled what median is and figured out what the real impact is. But of course, like so many other things that we see in the real estate world and in politics and in the economic things, all that kind of stuff, you get this sort of prepackaged news. You get what the sound bites are with no one actually really thinking about it. And let me just say, one reason why I'm a little bit better informed than a lot of other folks on this one is I used to be married to someone in PR. And journalists find it much easier to simply go with a press packet than to actually write their own story. Press packets are now a digital affair. They get sent graphics to use in their stories. They get sent stories, which they can then tweak themselves to give it their own personal voice. And of course, if you're someone who has to meet a deadline, that makes it a whole lot easier for you to finish your day's work. This has been going on. This isn't a new invention. This has been going on for an extremely long time. But who here, no matter where you work, doesn't know that one guy or gal at work that, given the opportunity to turn what would be a 2-hour job into a 20-minute job, regardless of the ethics involved, would go ahead and do that? I think we all know several of those folks that might do that. And of course, just as many of those folks work in journalism as any other profession. So sadly, that's kind of the case. I wanted to point that out. I'll include a link to a story that actually discusses that pretty well. And you can kind of go for that yourself, because it actually goes on to share with you the real statistics in terms of where the majority of folks' incomes are going. The distribution does not support this idea that everyone got a pay raise. So, like so many things, scratch the surface just a little or pay a little bit better attention and define some of the terms that they're talking about. And sure enough, you end up with a story that's very different from the headline you're being sold. Okay, so let's go ahead and jump into this article relating to 6 trends making housing worrisome. First off, too pricey. Home buyers said pricing was decidedly the top concern about buying this summer. And I think that that's absolutely true. But it goes deeper than that. I think that it's not just that oftentimes people will approach me and talk about real estate. And even back when things were ramping up before they went completely nuts, right? In 2006, 2007. The idea was all of this property was going up in price. And there was some element of, wow, this is crazy. But there was always this fundamental belief that ultimately, well, these properties were just worth that. That was the demand. That's what's going on. With very little kind of grokking of the idea that they could go down in value. You have a different mentality associated when folks talk about pricey real estate now. They don't just say stuff is super expensive now. It's not only is it super expensive, but I expect that in some period of time over the next few years that it may be worth less than what it is today. That absolutely speaks not just to confidence, But then what that confidence feeds, right? That feeds into whether or not folks will take action. And then you see all of these other numbers we've talked about. If you've been listening for a while, we've talked about a lot of different things. And all that stuff starts to gel. You start to get a little bit better of an idea, just on a gut level, of what's going on with the market. When you realize all of these various things that we've talked about, and that this idea of priciness is even a little bit more subtle. It's got some subtle definitions to it that are different than when people say it's expensive, but hey, that's the way it is. That's the real world. Folks are saying it's pricey, and that's not the real world. The article goes on to say that that's seemingly logical. 28% of 1,800 home buyers polled cited affordability as their major worry. A survey from the Redfin brokerage found, the National Case-Shiller Index shows prices are up 36% from post-crash lows of 2012. Pricing worry got a larger response than the next two anxieties combined: competition from other shoppers and limited inventory. And also, affordability has also been a concern all the way along, but the mentality of the concern about affordability, I think, is different from previous years in the ways I just discussed, in that it's not just real estate is expensive now, it's also coupled with, and I don't think it's worth what it's going for now. So that represents, I think, a different shift in the mentality of folks who are out there buying. And I think it explains an awful lot of why folks are deciding to rent or live with their parents or do other things rather than jump in and do that. But of course, we still have way more buyers out there than we do inventory. Just imagine how many more we'd have if that confidence was up there, because there's nothing else that should be holding them back. It sure isn't interest rates. It sure isn't access. It sure isn't low down payment loans, because all of those are out there. There's even an article that came out today talking about how FHA, I believe it was FHA, again, into the weeds for me. Let's see. Yeah, here it is. The GSEs. Remember what that stands for? Government-sponsored entities. That's Fannie Mae, Freddie Mac, all of those guys are talking about raising conforming loan limits in 2017. So they're willing to jump into bigger loans. Again, something that was going on before. So something that we should absolutely be worried about. All right, next on our fabulous list is too old. If pricing is high, one could lower their housing expectations, yet most shoppers apparently don't want to bargain hunt the old-fashioned way. Fixer-uppers may be out of fashion. To make this point, they're quoting a survey of 1,250 adults in the United States from Coldwell Banker Real Estate and Parks Association, where they found that 71% of folks out there want a move-in ready home. Well, that's interesting, right? I think that is something that folks who are doing flipping, obviously you want to be a move-in ready, but that's actually something that I think is an interesting trend. And if you're trying to sell your home, I think this is actually an interesting point. It would really fly in a more competitive marketplace. If you're in a market like mine where stuff is just really tending to go, it really argues to the point that if you see any defects in your home, that these are things that you should repair before you market it. And I don't mean defects like something leaks. Of course, I mean, that's obviously would fall into the move-in ready category. But if you have a very old kitchen, very old master bath, I think it makes sense. And I've just ran the numbers on my own property, for instance, as I've mentioned quite a few times. I am a hair's breadth away from committing to, instead of holding this property, selling it and then moving into something else. And I've been considering what my options are. And after doing the math, I've discovered that if I go ahead and get my master bathroom done and my kitchen done, I can recoup double my money. So if I spend, let's just to throw out round numbers, if I do $50,000 worth of work, I will be able to sell my home for $100,000 more, and it'll sell more quickly. I mean, all the analysis that I've been doing and the temperament that I've been seeing among buyers is that that's what they're looking for. They're looking for something where the work's done. They just need to move in and everything is set the way they want it to be. So I think that's something you should consider in yours. And I think that math may apply to almost any size property. I'm in a price zone here where it absolutely makes sense, but you'll want to run the numbers, make sure that it makes sense for you. And in order to do that, you're going to have to get a little bit more insight into local properties that are for sale in your marketplace. You're going to want to go to those open houses, check them out, see how updated they are, track them, and then see how much they end up selling for. The odds are that you'll want to work with a real estate agent to do this, just so you're not missing any data. And it'll also depend on your state. Some states aren't going to allow you to find out what a home sells for. But typically, the faster a home sells, that usually means it's going for a little bit closer to, if not over, the asking price. So you might be able to ballpark it. So if you're in an area where you're not allowed to find out what a home sells for, it may be a little bit more difficult to run those numbers. 45% of those polled said move-in ready could mean new construction. And new home sales nationally are at their highest in nearly a decade. And again, this is a topic we've talked about before. It has nothing to do with some big mental move to I'd rather have a new house. It is simply those are the homes that are available. We have such a low inventory on existing homes that's really it. If you want to buy and you want to buy now, and it depends on it doesn't even depend on if you're just looking for inventory. All you need to do is be in a marketplace where you've lost 5 bids on 5 different houses and realize if you buy a new house, it's just a question of you going in and signing on the dotted line and it's done. It's first come, first serve. There's no auctions. There's no bidding. You go in, and as long as you're in there before someone else is, you're going to get that house. It's just a question of you filling out the paperwork. Next, too much rent. What's getting folks to buy? Cheap mortgages, solid job markets, investment potential? Nope. High rents are a big motivator. I think this one's kind of interesting too. Redfin survey found the high cost of renting was a sharply growing reason cited by the most recent buyers. Now, this is interesting too because we have to figure out where does that price fatigue kick in. We calculated our price fatigue for San Francisco and we anticipated when that mushroom cloud of folks leaving San Francisco would grow and they'd start looking at buying a property in an area outside of San Francisco to take advantage of lower prices, but still within that reasonable range for commuting. I think the same kind of dynamic here is absolutely taking place with rents. Now, rents will continue to go up as long as what it costs to purchase a home goes up. So if we are in a situation we're starting to see the top end of the market, if you're someone who bought as a landlord and you were anticipating on being able to really crank up your rents over the next year, that may not be something you're going to be able to do, assuming in your marketplace we do see sort of a stagnation in prices. Now, this summer, 22% of all buyers surveyed said rents made them buyers versus 13% a year ago. So clearly the influence of high rents is absolutely jumped since last year. Now, among first-time buyers polled, what they had to pay the landlord motivated 45% to buy this year versus 25% in 2015. Now, we're going to go ahead and jump on to the next item on this list, but before we do, we're going to take a quick break, so don't go anywhere. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're basically running down the 6 trends making housing worrisome according to the Orange County Register. Kind of like analyzing each one, seeing how valid of a point it's being made, and maybe even trying to get a little bit more insight into the realities underpinning some of these points. So far, we've talked about things being too pricey, too old, too much rent. Now we're on to gap too big. Now, homeowners, according to the article, homeowners probably should be more optimistic than renters about the housing market, but it takes bullish renters to create the house hunters needed for owners to sell. So, this article says we should ponder the Zillow Housing Confidence Index based on a national survey of 10,000 American renters and homeowners. Any score above 50 is viewed as a positive outlook. Now, the overall index was 67.3% for July, up 0.8 points from a year ago. Homeowners scored 71.3 for July, up 1.7 from a year ago. But the renter index was only 61.2 in July, down 0.6 points from a year ago. So according to this, these swings created the largest owner-renter confidence gap in the 2 years since this index has been produced. It prompted Zillow's chief economist, Svenja Gudel, to say these trends are not sustainable in the long run. And absolutely, the disconnect between those two things, I think, is interesting. But I also think that it's one of those things where the difference isn't the leading indicator, right? The difference is simply telling us what is already going on out in the marketplace. Of course, people don't want to be paying this much in rent. But as the key factor, the thing that we need to keep our eye on that's going to inform us as to when these two things will come together is when property values stop going up, when the cost of purchasing stops going up and rents also stop. Now, if rents continue to go up, or if home sales flatten and rentals don't, well, then you're going to see the folks eventually doing the math and realizing now is the time for us to get out of this rental and move on to a purchasing scenario. But again, in order for that to happen, it's an inventory problem. We've talked about this a million times. Inventory has to change in order for those numbers, I think, to start going down, unless there's some other external force that pushes it. And we've talked about a lot of other different external forces that could potentially push it. Hopefully none of those things happen, because it would basically throw us into another scenario like we were going through back in 2006. All right, next, they talk about things being too popular. When your real estate professional becomes your best buddy, be nervous. The industry's image, as calculated by Pollster Gallup from a survey of 1,032 Americans, is now higher than the favorability of all U.S. industry for the first time since 2006. Gallup reported that 44% of Americans view the real estate business favorably, versus 21% who see it negatively. That's a plus 23 rating, up from plus 15 in 2015 and minus 40 after the crash in 2008. Let's see. So, and I guess, and we're seeing so many new investment devices being created around real estate, or continuing to, in exactly the same way we saw things being created last time. Now, obviously, when we were monetizing subprime loans, that kind of practice is still happening, but supposedly we're trying to create these out of things that aren't made out of such risky vehicles. I'm not confident of that. We've done tons of shows on that subject over the last 6 months to discuss these various things that are being done that really are a little bit creepy, that remind me a little bit too much of just before the last downturn. Next on their list, too bullish. The value of real estate stocks on Wall Street is so high that research, and this one is creepy, Wall Street is so high that researchers at Standard & Poor's have decided this month to retool its widely watched S&P 500 stock index. S&P's tweaks will better highlight the real estate investment trust shares tracked by this Wall Street benchmark. That's because the value of these stocks more than quadrupled since the mid-recession bottom. Returns almost double the rest of the bull market. So all these various things in emphasis here, all this attention being thrown towards the real estate markets. And again, this idea that here is an opportunity for us to get ridiculously rich, and all that depends on continuing increases in real estate prices. Does that sound familiar at all? Once you get all of these other forces, once it translates beyond just what a buyer and seller agree to in terms of price on their property, once it goes beyond what that real estate agent has negotiated in terms of their commission, once it goes beyond all of those things, and now it's becoming a stock market issue, as it did last time, I actually think it's time to put on the brakes. We need to be very cautious. We need to be very concerned about the direction things are going. All right, so that was their 6 points. Another article that I thought kind of dovetailed into it kind of nicely was from HousingWire. The title of the article was, "Is California's housing boom finally coming to an end?" California home sales started to temper out in August following the previous month's tumble in sales. California's housing market reached a nearly 4-year high not that long ago. But the strong momentum quickly came to a halt in July when sales fell from previous years, the previous year for the first time in 18 months. We've talked here about how there have been some very interesting trends in terms of slowing, not just slowing of growth in some areas and full-blown flattening in other areas. August was up 1.1% from the revised 415,840 level in July, but it was down 2.2% compared to home sales a year ago. Again, that's a tough number to pin down because some of that could clearly play into the fact that we just have so little inventory. Let's see. California Association of Realtors President Pat Ziccarelli. I just want to say that name again. Pat Ziccarelli says, quote, "We are seeing the market tempering. Two of the region's least affordable counties, Marin and Santa Clara, my county, saw sales fall from a year ago, while Contra Costa and Sonoma counties experienced more modest slowdowns." My most recent experience, even down here in Morgan Hill, which is the extreme south end, and this is a bedroom community for Silicon Valley. We're still seeing multiple bids. The fact that we have slowdowns in terms of what they describe as slowdowns, I think they're referring simply to the number of homes sold, which is absolutely correct. But we're not seeing that dramatic drop in prices. I don't think we'll see a dramatic drop right off the bat, but I think that slowing will come, and I think winter might be a very interesting time period to take a look at what those deals are. They go on to say, conversely, in many parts of the Central Valley where homes are more affordable and demand has been relatively strong, home sales posted healthy increases. Likewise, sales of condominiums statewide were strong thanks to their relative affordability. Yeah, and that's what they're going for. What's available? Those are the last things people tend to want to buy. Everyone starts off looking for a single-family residential home, and then they start being willing to entertain condominiums when they can't find single-family residentials. For the fifth straight month and at its highest level in nearly 7 years, the statewide median price remained above $500,000. Remember, that's a median number. That simply means that half the homes were above that number and half the homes were below that number. Whenever they start quoting stuff like that, I always want to go pull up real numbers and see what it actually was reflecting. Quote, with active listings in the lowest price tier dropping more than 27% from the previous year, the median home price of the lowest price segment of the market was pushed up from $185,000 last year to $205,000 this August, while the next price segment of the market has risen from $300,000 to $320,000. Yeah, so, and I guess I wish they would talk a little bit more about averages rather than medians on some of these things, and these are absolutely numbers that get pulled out. So like I always like to do, let's try to get a little ground truth out of this, right? They want to talk so much about median. Well, let's turn it around and let's talk about averages for a minute. I'm going to pull up the data for all of Santa Clara County, and we're going to look at the average sales price and see where we stand. So from October of 2015, we declined. We started off at, let's see what the number shows here, and this is for Santa Clara County, so that's the entire of Santa Clara County. The average sales price in October of 2015 was $1,082,144. Now that declined month after month until we got to January. Very normal for that season. Then, of course, we got the summer buildup. Now we entered into January with average sales price of $958,297, and then over the next 4 months up until May, we saw price increases where the average price in May rose up to $1.219 million. Then we started to see a decline, and we actually started to see that decline a little bit earlier than usual, and we talked about that here on this show. It declined all the way until August, where it came in at just over $1 million, and right now the average price in September, and we're a little bit more than halfway through, is $1.1 million, so it's actually increased. So that kind of gives us some insight into what's going on, at least with average price, continuing to go up. And we're tending to sell more, right? So the volume is still up there. Now let's also talk about months of inventory for a second, because that's kind of an interesting number. It's been relatively fluctuating ever since October of 2015. But as of right now for September, we have 2.5 months of inventory, which is still extremely low. but that's a huge jump. We'll have to see what the numbers are at the end of September. But if it continues along this trend, I mean, in August we had 1.4 months worth of inventory. So, and what to figure out months of inventory, you figure out the rate at which homes are selling, and you divide the total inventory by that amount, and it gives you, and you divide it by how many homes sold in the month, and then that gives you an idea of the months of inventory, how many months it would take you to sell off what you've got. So it's interesting, I think, that it's gone up. It's been relatively flat ever since March, with a peak in February, and then relatively flat low. I mean, below 1.5 months. It has stayed below 1.5 months for all year except for February, where it reached 1.9 months. And anything under 2 is ridiculous. It's a very robust market. It's very much a seller's market. If we take a quick look at the amount of days it takes to get a home sold, the amount of days peaked in January of 2016 at still a very ridiculously low number. In January of 2016, for all of Santa Clara County, it took, on average, 33 days to get your home sold. That proceeded to drop dramatically right up until May, and in May it dropped down to 19 days, and then ever since May it's been going up. It peaked in August at 27 days, and so far in September the average is 26 days. And obviously we haven't finished September, but that kind of at least gives us an idea of where things are. So a totally normal progression of how the days on market goes. But again, all of these numbers, despite the fluctuation, are all ridiculously low numbers in terms of how long it's taking properties to get sold. So clearly, plenty of activity, plenty of buyers, plenty of things happening, which doesn't spell the kind of trend they're sort of trying to sell here. And I think a lot of what's fueling these headlines, they're trying to generate more activity by generating more buyers, and they're feeding the wrong side of the equation. It's got to be about feeding the listing side, not the buyer side. Now, finally, I thought it would be interesting to take a look at the number of new listings added each month. Relatively low in October, November, December, a little bit of a pickup in January, then it took a big jump in February. And again, the entire county of Santa Clara, which includes all of Silicon Valley. But there were 1,400 new listings in February of 2016. Then it jumped in March to 1,959 and kind of gradually dropped until we got to August, where it bottomed out at 1,581. And so far now in September, we've had 1,020 new listings in the month. My guess is that by the time we get to if this trend continues, we may actually see a lot more listings in September than would be normal. In fact, it might outpace July and August, which would be very interesting. If you're in your marketplace and you're looking at these numbers and you're working with a realtor and you start to see a jump like this, particularly at this time of year, if we do see more than normal increases in listings in September of this year, that is good news for me. And it's good news for you because that means you may be able to find a much better deal in the wintertime. You're going to see a thinning of buyers during that time in a lot of areas where buyers don't tend to go out in the wintertime unless they've got a huge amount of motivation to really push the process and make something happen as soon as possible. So usually the competition is a little bit lower. But if we feed the machine with more listings coming up, that would be great. I think that would be a great trend, and we definitely see some good opportunities for buyers, investors, and real estate entrepreneurs to take advantage of that. So there's a little, I can't talk for the whole state of California, but in terms of just taking the ground truth from Santa Clara County, definitely we need to put a different spin on some of those stats that are being pushed on what's going on with California, because it doesn't really seem to be telling us much about what the ground truth is in terms of what's actually happening in the marketplace. All right, folks, I am always appreciative of the fact that you choose to spend your valuable time with me, if just for a relatively short period of time. But I hope it's valuable for you. I hope you get some really good information out of it. As always, thanks for listening. I'll talk to you all next time.